Happy New Year. It seems like we just did one of these at the end of the third quarter, and quite a bit has changed. Back in October, we were all worried about the upcoming election. We were worried about the fiscal cliff. At that point, it looked like Israel and Palestine may actually have some military action against each other. And to some degree, we might not be happy with the outcome, but there are a fewer things to worry about now than perhaps just 3 months ago. Today's theme, and every quarter those that are on this call often know that I try to come up with some kind of a theme. Looking at 2012, I would have to say that the theme was probably things turned out better than expected. You know, it seems like all last year we were so worried about the news media and the headline risk, and it wasn't the worry about the election or what was happening in the Middle East or Europe. It was worrying about fiscal cliff and all the other issues that the market, anticipating these fat tail risks, also valuated the market from the standpoint of protecting itself against these risks. And as a result, the market for a lot of the year was undervalued. And then we had a little bit of a bump the fourth quarter of the year, which helped propel the market to where we ended. Why do we do these? We do this for a couple of reasons, and the biggest is I do believe the economy does matter. We're less concerned with short-term volatility, less concerned with what happens one day versus the other, but certainly we want to get the big things right. And it seems to me that the big things often have to do with the economy, and in particular Federal Reserve policy. Are they expanding or contracting? Is the U.S. dollar rising or falling? Is the economy rolling into a recession or coming out of a recession? These things certainly can have an impact on how portfolios are structured and what types of assets we might be interested in investing in. So what we do every quarter is try to dissect several major components. We look at growth, we look at jobs, whether they're being created or whether we're increasing the number of unemployed, corporate profits, inflation, and lately we've been talking a bit about interest rates. All of this is in an attempt to answer a couple of questions. One, where are we right now? And more importantly, where are we heading? If you go back to the title slide, I also indicated perhaps more of the same. And I do think all in, this year will look a lot like last year from the standpoint that we'll have some degree of volatility, certainly between now and the end of February. The economy probably will slow down here. First half of the year will indicate why in a moment. And then we expect a resurgence in growth second half of the year that can certainly help with corporate valuations and stock prices. We do all of this because we want to make sure that you stay informed and as a result stay balanced, stay diversified, and more importantly stay invested. With the kind of volatility we've had and the big swings we've had several times each year, it's almost impossible to time the market. We're never going to get out, nor are we going to get in at a proper time. The risks are always greatest when the opportunities are also the greatest, and as a result, we often miss out. So staying invested, staying diversified seems to be the best approach. The four themes that I'd like to talk about for this quarter are as follows. Let's spend a little bit of time talking about the fiscal cliff, the deal that was just struck a couple of weeks ago. I also want to talk a little bit about the Federal Reserve, and in particular the last minutes, the last open market committee minutes that were read, and whether there's been a shift there a bit in the Federal Reserve's focus and what that means. We'll also talk about where we are from a global economic point of view. Is there still room for growth? And then I'm kind of combining both threats and opportunities. And here I'll discuss a couple of slides that we didn't discuss elsewhere in the presentation, and just talk about how in some cases these things are helping to remove some threats and might improve valuations, and other areas that perhaps have run their course and may not be quite as strong a buy recommendation as they may have been. So where are we? Well, as we finished the year, the market did well. Looking at this particular slide as an example, we finished the year with the S&P at 1426. I want you to note that that's high that we hit on October 9th, 2007. Market was up today, and many announcers from Fox were saying we hit a new 5-year high. New 5-year high, not new all-time high. And we can also see that that 1565 wasn't a whole lot higher than 1527 back in 2000. Difference is back then the stock market was valued at 25 times earnings. In October of 2007, 15.2 times earnings. And today, not far off that mark, about 12.5 times earnings. The market is still reasonably cheap. We've come a long way in the last 2.5 years or so, up 111%. And you can see this past year, 2012, starts right here. We had a big run up through April of last year. Fairly good sell-off during the spring and early summer. Another run-up, and then another big sell-off to the fall, and then a little bit of a recovery going into the end of the year. Quite a bit of volatility. Last year, though, to a large degree, was kind of a risk-on trade. What I mean by that is those segments of the economy, those segments of the S&P that normally would carry more risk and volatility actually performed well. If you look at the big winners last year, financials did phenomenally well, up 28%. They had performed horribly the last several years since the credit crisis, but they came back with a vengeance. Consumer discretionaries, all those things that we spend money on that we can quickly eliminate in the event that we fall on hard times, were up nearly 24%. Things such as technology did well, things like healthcare did well. The areas that didn't perform well are those that are far more conservative. Energy as a group was up only about 4.6%. Utilities, which did phenomenally well a year or two ago, was up only 1.3%. And consumer staples, the things that we spend money on all the time, toilet paper, cereal, etc., also didn't perform quite as well. So it was really a risk-on trade. Those things that were more risky performed a bit better. Looking at last year, all segments performed well. It didn't matter whether it was growth or value or something in between called blend. Didn't really matter whether it was large, mid, or small cap. You had generally an uplift with all asset categories, and there wasn't much of a deviation between one or the other. That's typically not the case. The fiscal cliff wasn't. The deal actually will impact a number of areas of our lives, both the economy as well as federal budget, and it will have some impacts as well on some of us as investors. Let's take a look at the fiscal cliff, and let's look at it from the standpoint of federal finance. A couple things I want to discuss here is, at this point we had the revenue end of this argument. We haven't had the budget cuts and the arguments that will come along with what do we cut. The problem is if we look at the budget and we look at what we spend money on, there are a number of areas, the big ticket items like defense and Social Security and Medicare and Medicaid. These are areas that we really need to have some serious discussion on, both in terms of reform as well as some question about how we're going to go about funding those going forward. Other, which represents about 14% of the economy, and non-defense discretionary, that's everything else that runs through the government, the post office, Department of Agriculture, Department of Education. These are areas that will involve some degree of argument as to what we cut and where. Most of this will yield very little improvement. The big improvement will come from the big arguments and the big discussions here. As such, when you look at our budget and you look at where money is coming into the government from, 32% comes from personal income tax, only about 7% from corporate income tax, and about 23% comes from Social Security. We're still building and adding to the Social Security Trust Fund. And then there's about 6% from other. Those are transfer fees, etc. That being said, clearly 2/3 of this budget is made up by government borrowing. And this is the area that needs to be dealt with. And we've heard this to be a problem year after year, and certainly the last several years, and certainly last year leading up to the election. One thing that I found interesting was this slide, which talks about federal outlay and federal receipts. And this is presented as a percentage of GDP. If you think about it, and certainly looking at this, I was quite surprised that the orange line, as an example, is outlays. That's government spending. And government spending as a percentage of GDP is 22.8%. And that's come down significantly. It was well in excess of 25, nearly 26% just a few years ago. Moreover, revenues have come up a bit as well from where they were just 2 years ago. Now, part of this may actually be individuals who elected to pay taxes on capital gains, or companies that elected to issue taxable dividends this year as a result of fear that tax rates would go up significantly the following year. When you look at the deficit and, more importantly, the debt, they're both obviously very important issues that we have to contend with. The deficit is something that we as a nation have been running for decades. It is not quite as important as the debt. Our debt level, or the debt of the nation, is certainly a much, much bigger issue. And debt is nothing more than the accumulation of all deficits. That being said, debt is important, but it's only important as it relates to GDP. As an example, somebody who has a $500,000 mortgage debt on an $80,000 a year income is in trouble. Somebody who has a $500,000 debt on a $750,000 income doesn't seem quite as dramatic. Going back to this first chart, which talks about deficit, the gray bars represent the CBO's forecast as to how the deficit was going to drop. Now, this forecast has everything to do with what the expectation was in terms of tax law. And going into the end of the year, the expectation was that the Bush tax cuts would be eliminated, everything would get restored back to pre-Bush, and as a result, tax revenues would soar, deficit would drop significantly. The orange bar, which also shows a marked reduction in deficit, is actually post-compromise. And you can see that obviously the deficit will not drop nearly as much as it would have otherwise, and part of that is just because we didn't get the large tax increase that we could have had. A couple of things, though, we need to note here, which are positives. Our deficit as a percentage of GDP every year for the last 4 or 5 years has dropped significantly. In fact, compared to where we were in 2008 and 9 and 10 and 11 and 12, and compared to where we are now, it's dropped significantly. We're expected to be close to 6 or 7% of GDP this year. Next year, that's going to be more like 4%, and then it'll eventually, after 2014, drop below 4%. That's important because when the deficit is less than 4% of GDP, you start to see a reduction in debt. And you can see that here. Going out to about 2014, right here, which is right here, you can see that actually debt starts to drop. It does not drop nearly as much as what it would have dropped had we had the draconian increases in tax rates, but it's a drop significantly. And rolling out 10 years, effectively debt as a percentage of GDP will be approximately the same as it is or was at the end of 2012. That's projected based on what has happened so far, which is the compromise to the fiscal cliff. Now, if we have some reduction in spending as a result of the debt ceiling, that can really help reduce this significantly. So national debt isn't expected to increase, as a lot of people would have you believe. The other thing is, and I'm not saying that this isn't bad, but what this says is that when you look at GDP, that's equivalent to our income. We never quantify the government's net worth. What's the value? What's the retail value of our military? What's the value of the lands and the buildings and all the other things that the government controls? That would be net worth. GDP is output, it's income. And effectively our debt, as not debt service, debt as a percentage of the country's income is 72%. That would be equivalent to somebody who's making $100,000 a year who has total debt, including mortgage, of about $72,000. It's not ridiculously bad. It's a problem. It will get rectified, hopefully sooner than later, and especially with some changes to this previous slide here. So this is hopeful. There have been some adjustments and some changes. It's not just more of the same. A couple of other things. In terms of GDP, while the recovery has been lackluster, we've had recovery nonetheless. And in terms of the $625 billion of output that was lost during the credit crisis, we've recouped nearly $1 trillion of output. It's anemic recovery growth compared to other recoveries, but it's still growth nonetheless. And a couple of other issues, going back just for a second, one of the reasons that there's any improvement here at all is in part because one of the things that they pushed through was the payroll tax cut was eliminated. So that was a 2% hike in Social Security and payroll withholding. And that impacts every worker on the first $113,700 of wages. So for the bulk of the working population, it affects everybody. And that means that first pay period of the year, everybody encountered a decrease in take-home pay. The concern with that is, what does that do to GDP? Could that cause us to slip into a recession? People will have less discretionary spending, less money to buy pizza or go to movies or rent videos or whatever the case might be. And our GDP, which is the country's income, so to speak, over 70% of it is individual personal consumption. So what impact does that have? Well, I believe that it will not cause a recession. It will probably cause GDP to slow up a bit, certainly slow up from the 3% that we had in the third quarter of the year. And the reason a recession is because in a lot of the big ticket areas that tend to drive the economy, we're still experiencing pent-up demand. Small vehicle sales, light vehicles, we're getting to the point that they're getting very, very close to average. Both General Motors economists as well as Ford Motor Company's economists are predicting even greater vehicle sales this year compared to last. And the reason is, still today, the average car on the road is over 11 years, and at some point you exceed usable life. The other thing we're noticing is that we're beginning to start to see home starts. Still not quite a half, but nearly half what the average is, 100,000 units versus 1.3 million units. We just aren't creating enough houses for demand. And as the economy does improve at some point in time, you'll have a lot of people that are cohabitating because of budget constraints, start to go in and get their own places. Children will move out of homes, etc. So both of these things will certainly help avoid recession. The other thing is the consumer's balance sheet is looking very, very strong. Household debt service as a percentage of personal income, this would be the exact same chart as that GDP chart that I showed you, but on a personal basis. As of the fourth quarter of last year, 10.4%. In other words, on average, people spend 10.4% of their disposable personal income on debt service, mortgage, interest rates, and payments on credit cards, etc. That's down from 14.1% in the third quarter of 2007. That's when the market peaked. And frankly, it's lower now than ever in recorded history since they've been keeping tabs of this data point. Corporate finances are also in very, very good shape. Since 2007, corporations have deleveraged significantly. The total amount of leverage on books is about 107% compared to 173%. They've got rid of a lot of debt. They've refinanced debt, they've paid off debt. And as a result, companies have the ability, certainly, to lever up if they wanted to. In fact, if you look at corporate expenditures, which is this orange line, and compare it to the gray line, which is internal funding, meaning cash and cash flow that the company has. And you can see, generally, companies spent very close to their internal cash. Today, you're seeing a huge spread in between, which means today companies have the ability to finance 100% of their capital expenditures from cash flow. They do not have to go to a financing source or a local bank. They effectively are underspending cash flow, which gives them the ability certainly to weather the storm, if there is one, and more importantly, increase dramatically spending. One other issue that you'll hear about, and it's a non-event, and that is margin share of earnings per share growth. Stocks go up as a result of two things: improvement in margin and also improvement in earnings or revenue. And coming out of a recession here as well as the dot-com recession, you see a big spike in improvement in margin, improvement in productivity. And then that over time wanes, and you might have very little or zero margin growth. As long as you have earnings growth of any type, you can still have stock market improvement. As you can see here, during the 2003, 2004, 2005, 2006, we had very little margin growth, but the stock market continued to improve throughout. And we could see the very same thing this coming year. In addition to what they've done this past year, somewhere between 4 to 6%. Another thing we need to focus on a bit is the higher tax rates. As I said before, this here, the increase in payroll tax, is really going to have an impact on the economy. That's why we expect slow growth or very little growth first half of the year, improved growth thereafter. And while the increase in wage tax, capital gains, dividends, and estate tax are essentially on quote-unquote the wealthy, defined as $450,000 or more, and they were all increased, they weren't increased nearly as much as they could have been. And when you look at the rates that are present today and you compare those rates to historic levels, you'll see in most cases the rate we're paying at the high end on wages compared to where we would have had marginal rates previously in terms of what we paid on dividends and what we paid on capital gains. We're still at the lower end of the range. Not great, but it's not as horrible as a lot of folks make it out to be. This alone, this increase in taxes on dividends, will not dissuade people from buying dividend-paying stocks. The increase in capital gains will not dissuade people from investing capital in things that can produce capital gains. It's still significantly less than earnings and wages. All said, the market today is still underpriced. When you look at the PE currently compared to historic PE, historic is 13.7 versus 13.1. Market tops are usually put in when PEs are dramatically above average. For example, in 2007, the PE at that point was about 17 or 18 times earnings. I stated that before, not 13.7. In fact, in 1970, 71, going back to that period of time when we had 2 or 3 year period where the market from top to bottom dropped about 45%, PEs were in that 17+% range. So if PEs start to move up and get to average or a bit higher than average, we'd have to look at earnings growth, but it's not a sign that the end is near. Let's talk about the Federal Reserve. Their minutes were kind of interesting. They basically said, hey, we're really not worried about inflation in the near term. In fact, through the end of the year, core CPI was 1.9%, which is low relative to historic. And actually, it was lower than headline CPI, which it usually isn't. Headline is a function of all of these areas here. Core is all of those areas less energy and food. So generally what happens is you see headline being a bit higher than core. That's not the case. But at 1.8, 1.9, it's not a lot that the Federal Reserve has to worry about currently. As such, they said that they're really not going to worry about inflation until unemployment gets down below 6%. So the focus is they may let inflation move up here a bit in the hopes of bringing unemployment down. That's a change in focus. That being said, inflation is still a concern, or should be a concern, looking out longer term. This is it's an interesting slide. Inflation occurs when you have too few dollars chasing too many goods, right? Or actually too many dollars chasing too few goods. M1 and M2, very low. In fact, M1 and M2, the supply of money, the money base, really hasn't changed much in the last 4 or 5 years. The reason is right here. Federal Reserve has been using dollars, and what they've been doing is they've been, instead of releasing those to the bank, they've been buying treasuries, and they've been buying mortgage-backed securities. So money that normally would have been released or could have been released is being held at the Fed and being held at the Fed as bonds. Fed liabilities, to a large degree, are excess reserves. That's money that the banks own that they've decided to keep at the Fed because they're getting paid 1/4% on. And if the banks had it and nobody is lending, or the banks refuse to lend, they're earning nothing on it. Now, here's where the problem is. At some point, as is expected here, interest rates are going to start to rise. When interest rates rise, the bank, the Federal Reserve, is going to have to start paying the banks a bit more. If the banks start withdrawing excess reserves because they can earn more by lending it, the Federal Reserve is going to have to get rid of some of these assets, and they're going to have to start selling these assets. Well, if these assets are all very low-yielding treasuries, for the Federal Reserve to effectively get rid of them, they're going to have to incentivize the purchaser, meaning sell these things at a discount to a higher yield. Once that happens, money supply starts to increase. So what happens is you can expect to see rising interest rates and perhaps a bit of rising inflation as well. Probably not something to worry about this year. If we start to see any rise at all in policy, it might not be until 2013. The problem with this is interest rates have no place to go. As of the end of the year, a 10-year Treasury was yielding 1.76%. Inflation was 1.9, and that's before taxes. Somebody buying a 10-year Treasury, there's a very strong likelihood they will earn nothing. In fact, in purchasing power, they're almost guaranteed to lose money. And you can see during a huge, long-term rising interest rate period, when corporate bonds were yielding 3 and inflation was averaging 5, there was a real annual loss of about 2% or so. And we can see over the last year, interest rates have dropped pretty significantly. If you look at the yield in 2012 year-end versus 2011, the broad market, which is the ag, dropped on average from 2.2 to 1.7. Corporate bonds dropped from 3.7 to 2.7. That's a huge drop in yield. Emerging market debt dropped from 6 to 4.3. High-yield bonds dropped from 8 to 6. That's important because remember, as interest rates do start to rise, bonds do lose value. 10-year Treasury, if there was a 1% rise in yield, you'd expect about a 9% drop. All bonds are not created equal. Each one has a different sensitivity to rising interest rates. High yield among the mix still looks reasonably attractive. Let's talk about the economy for a second. When you talk about the global markets, a lot of opportunity really rests on what the dollar is doing. We've been running a trade deficit for quite some time, and as a result, the U.S. dollar for quite some time has effectively been dropping, with rare exception. Anytime there is a global catastrophe, there's a flight to quality. Credit crisis, the dollar rose significantly. During the first Greek crisis in 2010, dollar rose. This past year, with the Arab Spring and then what was happening in Palestine and what was happening in Greece, dollar rose. But every time the catastrophe subsides, dollar immediately starts descending again. And that's sort of what we're seeing here this last part of the year. The reason that's important is when the U.S. dollar falls, international securities look a bit more attractive. International hasn't looked particularly well the last couple of years for a variety of reasons. One being that the dollar had generally been strengthening. We're beginning to see that change a bit. The economies also in emerging markets that didn't do particularly well this past year are expected to show some signs of improvement. This is quarter-over-quarter economic improvement. The developed markets are a different mix. In some cases, we're expecting to see still some weakness. France, Italy, U.S., Canada doing fairly well. Probably with the developed markets, in terms of economic change, it's probably more of the same. That being said, if the backdrop is a generally weaker dollar, and as we saw the last part of the year, the dollar started to weaken again right here, that helped to drive performance. So when you look at 2012 and you look at performance in US dollars, you would see France stock market was up 22%, Germany 32%, China 23%, India 26%, Russia 14%. Fairly significant improvement, and in many cases better return than their local currency. The exception was India, and part of that is because of the dollar's weakness relative to the local currency. Let's talk about valuations, because oftentimes it's at what price we buy is far more important than what price we sell at. The developed markets look reasonably cheap. Let me explain this chart once again. This gray bar shows the range of valuation based on their history. So in terms of Japan, this would represent relatively expensive based on its historic valuations, relatively cheap. The brown bar represents the average valuation, and the blue triangle or diamond represents where it is today. Japan, really undervalued. Canada, undervalued. United States, undervalued. Switzerland, probably average value. Germany, average value. For the most part, developed markets are generally undervalued, and you can see current PEs here compared to 10-year average PEs, and in most cases they're cheap. Japan 12.4 versus 17. United States 12.6 versus 14.3 as a 10-year average. So there is some opportunity in the European markets looking ahead, and certainly this year. Threats and opportunities. I mentioned something for everybody because really, if you are a glass half full kind of guy, you could find ample slides to indicate things look pretty good. And if you were a glass half empty kind of person, you could also find slides to say, here, see, this is a problem brewing. This year we had, or last year, 2012, we had an awful lot of fat tail risks, things that we were worried about. Well, what if this happens? What if that happens? Let's talk about a few of those and kind of where we are and what we have to deal with. Last year, certainly with the Arab Spring and the fighting going on in Libya and Israel and Palestine, there's all kinds of concern, and Iran with oil. And clearly, if you look at this map, you can easily see from a production point of view that the Straits of Hormuz is a significant choke point representing 17% of the global liquid fuel production. That compares to the Suez Canal, which is only about 2%. That being said, when you look at the fact that the U.S. is now a major producer of global oil, and while we consume 22%, we are also producing a significant amount. And as a result, our strategic oil reserves, both in terms of the government strategic as well as commercial oil stocks, are as high as they've ever been. And every single year, our total need for net imports continued to drop off. And the expectations by 2030, we may be completely independent of oil. One thing that will help accelerate that is this slide, which is natural gas production. Significant improvement in natural gas production, in part because of the shale gas. And as a result, our reserves are going up and prices are going down. This actually gives the U.S. a strategic advantage from the standpoint of natural gas when comparing BTU price. China pays $13.70 per million units of BTU compared to about $4 for the U.S. And that's strategic. If we convert our plants and whatnot to natural gas, our energy costs are significantly less than the same energy cost in China. Wages and those kinds of things might be cheaper in China. Energy is far more expensive. And all that kind of comes into the mix from the standpoint of where we're going to produce goods and services. The other worry was Euroquake, what's going to happen there, especially from a credit perspective. Mario Monti came in and said, look, we're going to do everything we need to do to ensure that there's ample credit available for all. And this chart certainly indicates that we've seen that this year in every single case. Portugal, Ireland, Spain, Italy, France, Germany, the cost to fund sovereign debt, or another way of looking at it, it's equivalent to a 10-year bond, has dropped precipitously. When they were going up, nobody was willing to lend. Cost to lend was ridiculously high. Those prices are coming down. There's a lot of liquidity in the system. As a result, it's far easier to finance and get things done in Europe. We talked about Europe being reasonably cheap. This slide is very similar to the one we looked at, except this is emerging markets. And here we're beginning to see some of the Asian markets are starting to get fairly expensive. In fact, in many cases, current valuations are well in excess of historic ranges. The exception is maybe China, which if you remember from a previous slide last year, they saw a deceleration in economic growth. They're expecting a resurgence. And you can see generally emerging markets are probably fully valued compared to developed markets. Housing in 2012 improved significantly. This is an absolute plus. And the expectation is that's going to continue for two reasons. One, inventories are still down and continue to drop, which really helps. And the other is, surprisingly, it's still more cost-effective to buy a home than rent. Nationwide, if you look at the monthly rental versus monthly mortgage payment, you'll generally see, on average, it's less expensive to buy and get a 30-year mortgage than to rent. Unemployment is still an issue. While the rates are down from where they were, they're still ridiculously high. And if you look at the total number of jobs lost versus the number of jobs gained back, we're still a long way from getting back to where we were before the crisis started. Several years, in fact. So something's got to change here. Unfortunately, the expectation is we may see a little bit of slower economic growth the first half of the year, and I wouldn't be surprised to see this number jump back up a bit. Some are saying it might get to 9 before it drops back. I put this slide in because this is kind of interesting, and I really can't quite explain it. I thought it was an interesting slide anyway. As of November, the most recent data available, this is percent of population age 16 or over working or looking for work. It's only 63.6%. It's as low a number as we've seen. If the bulk of new jobs are created in the small business sector, and small business people have been worrying about this fiscal cliff and what happens with taxes and Obamacare, etc., and jobs aren't being created, this implies that you have a lot of folks graduating college who are staying in school, pursuing advanced degrees. It also certainly dictates that there are an awful lot of folks out there that are on unemployment or have simply given up, or people in their mid-50s who have just decided to call it retirement as opposed to looking for work. That number's got to improve, and hopefully it will here at some point. The unemployment rate is also a bit bifurcated from the standpoint that it depends on who you're talking to. If you have less than a college degree, you're in an environment with 12+% unemployment. And if you have a college degree or greater, the unemployment rate is less than 4%. Speaking of wages and employment, I found this interesting. A moment ago, I mentioned that the U.S. has a strategic advantage from the standpoint of natural gas cost. This slide also suggests that the U.S., while still expensive from the standpoint of average monthly wages in U.S. dollars, this is over a 10-year period. This represents about a 30% increase over that 10-year period in monthly wages in the U.S. This represents a significantly greater increase, as does this. Brazil represents about a 250% increase compared to 30. China, about an 800% increase. As a result, it's becoming more expensive to manufacture overseas. And when you look at that versus, compared to transportation cost, etc., you may find that it's actually becoming less expensive to relocate certain manufacturing here in the U.S. I know just before the end of the year, General Electric mentioned that they were bringing back a certain amount of manufacturing. So that could actually bode well for a resurgence. I mentioned bonds, not a great place to be, no really panic situation yet. One bright spot still happens to be high-yield bonds. When you look at the spread between interest rates and default rates, they're usually fairly narrow. They're pretty wide here, and what that implies is we're getting spread, and that's the spread of high yield rates over treasuries as wide as they've been, and yet the default rate is about 1.1%. So as a result, there's been a fair amount of money flowing into high yield bonds last couple of years, and as long as the spreads remain, it's still a fairly viable place. This Kaydan chart shows performance of various bond sectors over the last nearly 10 years, and here's 2012. High yield performed really very well. Categories like Treasury inflated protected securities, munis, the aggregate bond index that everybody compares performance to, mortgages, and treasuries didn't perform very well. Treasuries were up about 2% last year, mortgages about 2.6, the Barclays Agg about 4. Whereas the Barclays Agg would contribute 7, 6, 5, 5, 7 in the past, it's contributing much less than that now. Corporate cash is still piling up on the balance sheets, and companies are beginning to spend that by increasing the dividend. Dividend rates increased quite a bit. That's dividends per share this last part of the year. Some of them may have been tax rate change involved, but the point is with corporate cash, you would expect to see an increase in merger and acquisition activity, and we're not. You are seeing some increase in capital expenditures for forward-looking growth, and they're doing this all by financing internally, which is also a great thing. Dividends, which are going up a bit, is also helpful in terms of total return. This suggests the last couple of years the component of price appreciation to dividend for the various decades. In the 2000s, whatever return there was essentially came from dividend, whereas in the 90s, mostly capital appreciation, 70s, mostly dividend, 60s, mostly dividend. Slower growth environments, dividends are a big, big deal. Over the vast period of time, 1926 right up through 2012, dividends represented about the same as capital appreciation. So it's encouraging to see that dividends still make some sense. Looking at dividends and talking about that global theme, the average dividend yield on U.S. equities still high compared to treasuries, which makes it still very attractive. But when you compare yields in Europe in particular, they generally, historically, are higher. We talked a bit about inflation. I just want to remind you that if we do see some degree of inflation at some point in time, the period that we will be experiencing is a period where we would generally have low inflation to rising inflation, as opposed to high inflation that continues to rise or high inflation that's falling. So here we have low inflation that's expected to increase. And in that capacity, equities, commodities tend to do much better than cash or bonds. So what are the takeaways? Best advice? Stay balanced, stay diversified, and also stay invested. The markets have been way too volatile to get really cute by saying, I'm going to get out of the market, I'll get back in when things are better. Diversification works. Looking at a very simple portfolio of S&P and some international and some Barclays Agg, those are bonds, compared to a portfolio that may include real estate and commodities, some emerging market debt, etc. Not only do the returns increase a bit, but standard deviation or volatility tends to drop. And if you look at this Kaydan chart, which talks about performance within asset categories, you can see that while it's difficult to pick a particular category that's going to do well continuously, if you pick a blended, diversified, globally balanced portfolio, the returns over time are really very strong and compound well on an annualized basis. The other thing I want to stress, because I know sometimes when the headline news is very risky, scary, we tend to want to de-risk and get out of the market. Most clients, and considering my clientele and my client base, I would be hard-pressed to identify names of people that this would not also apply. Most of my clients are still long-term investors. If you plan retirement, good Lord willing, you plan to live 30 years in retirement. If you've been retired for 10 or more years, you hope to be around another 20 years. And as a result, as long-term investors, the markets do a lot in our favor from the standpoint of averaging out returns. Unfortunately, in the short term, there can be a lot of volatility. This chart shows rolling 1, 5, 10, and 20-year periods. Green is the S&P 500, blue is Barclays Aggregate Bond, and this brown or purple is half stock, half bond. And you can see in a 1-year period, the range of returns any 1 year can still be significant in a blended portfolio. Not quite as dramatic as individual stocks, but as you start going on and saying, look, I'm going to be here 5 years or more, and we look at 5-year rolling periods, you start seeing a much, much better distribution. Whereas a blended portfolio, best rolling 5-year period was 21%, worst rolling 5-year period was 1%. When we look at 10 and 20-year returns, and you get to the point where the worst rolling 20-year was still 5%, and the average is 8.9, that should be our focus. And certainly that should be our focus with everybody who considered the lump sum versus pension decision last summer. It's important to focus over the long term. And by doing that, I think we become better investors. So with that, I'd like to open for questions, and while sending questions, if there are any, I just want to mention, hey, we certainly would like to help any friends or associates you might have. If anybody's a little concerned about the market, if they're looking for more value add, by all means send them our way. We would love to do a second opinion. If we can help them, terrific. If we can't, we'll let them know. If we can send them somewhere where they might be able to help, especially if there's a special situation, we'd be glad to do that as well. So with that, I want to thank everybody for participating, and let's look forward to an exciting and profitable 2013. Thanks so much.